Chargebacks, they're the thing you want to avoid as a final expense agent. What I'm going to be talking about today are the 3 strategies of how to avoid them, but also for you new people out there, define what a chargeback is and how it can absolutely ruin your career. My name is David Duford. I own Duford Insurance Group. We train agents nationally to sell final expense in person or over the phone. And if you're interested in learning more about joining Duford Insurance Group, go to davidduford.com. and check it out. And of course, if you want to join us live as we film these training videos, you can go to our insurance sales success free training site. That's at davidduford.com/ISS. I give away all of my best-selling ebooks for free, over 30 plus hours of free in-depth training in final expense Medicare annuities and ACA. There's a great forum, lots of stuff for free. Head over there if you want to check that out as well. But let's jump right in. First of all, what are chargebacks for those who are new to insurance sales? Well, it may surprise you to learn that when you make an insurance sale and a client lapses, that money you made ain't yours, at least not all of it. You see, when you make a sale in the insurance space, specifically final expenses, kind of my reference points here, but it's true no matter what it is you're selling. You are fronted money. You're advanced is the industry term for it. Put it in a simpler way, you get a loan for what is expected, keyword expected, to be collected. You get that up front in the form of an advance commission payment. You get it in advance of, in lieu of, the client actually paying on the premiums. So typically, when you sell a life insurance plan, depends on health products, some advance, some don't, you get 75% of the total commission you're going to get for the year up front. So if you're owed $1,000 on a case that you write with final expense or life insurance, most carriers are going to front you in advance of $750. So that's 75%. Sometimes it's 9 months. It's referred to 9 out of 12 months is 75%. Same thing. Okay. That assumes that you keep that money as long as that client continues to pay. But guess what Mildred does every once in a while? You know, she blows all her money on smokes and booze. She forgets that her policy needs to be paid on auto draft. And then when we go in and collect the money, there's none to be had. And our clients go into a grace period to catch it up. And a lot of times, you know, sometimes we can save them, sometimes we can't. But if the policy ends up lapsing, we now have a situation, and this is where chargebacks are problematic, where we as the agent owe back some prorated portion of the commission based on when the lapse occurred. So for example, with most companies, you owe back what you didn't earn as far as commission goes. So for example, Mildred paid 3 payments in before, missing a payment and then lapsing. We keep 3 months of that commission, but because 6 of the 9 months weren't collected, we now have to owe that money back. Now, in most cases, most carriers don't make you pay it immediately. They make you pay it over time. They give you some wiggle room. They'll even go so far as to let you write another piece of business to cover that amount. So it's not like you immediately are in collections, right? And you know what hits the fan. But you're in a position where if you write enough business that doesn't stick, you know, what you may owe $500 or $600 from one case, but that morphs into 5 or 10, you're thousands of dollars up the creek without a paddle. And it's your responsibility now to pay that off and get back to zero. Some of you out there watching that probably have never heard of this. And it's intentional. Maybe I'm, blowing the wind out of your sails or something. I don't know. But most agencies don't like to talk about chargebacks because it's scary, right? If you write a bunch of bad business, it's now back to you. But it's a part of the business that is real, that every agent deals with, and you need to know about it, the risks associated with it, and what I would call not eliminate it. It's impossible to eliminate it because it's impossible for everybody to know with certainty that they're going to do something, right? People just change their minds sometimes. But you need to mitigate it. You can lower it. There's some things you can intentionally do to do that. What I am charged to do with you today is to teach you those 3 methodologies, because what chargebacks will do if you don't pay them is that you end up in collections, you end up getting a credit report, you end up having collectors come out of you. And most important, I think, is that all the other carriers that are out there get notified when you owe money with chargebacks that you don't pay back. You're now put on this list called the vector, And the vector is like it's like a central reporting database that reports to all of the carriers, sometimes even agencies, when an agent owes money they have not paid and now has been reported. And what that does is it removes, in many cases, your advance commissions from being had with one carrier, even carriers that you don't have debt with, because what they're going to see is, oh, that person owes a lot of money. We don't want to advance some commission. They're not credit worthy or advance worthy because they're not keeping up with this. So you need to stay on top of this. You need to be aware of this. You need to be prepared to overcome it. And I'm going to give you some strategies to do that. Now, the first thing I'll address here, I kind of sense this in talking to you guys, is why even have advances, David? If we're saying advances are problematic and could cause debt and elimination in the business and all sorts of financial troubles, why should I even carry advances? And that's a great question to start off with. But if you think through the logical sequence, the problem with most business models is cash flow. Most businesses, in fact, fail because of a lack of money on hand to pay bills and manage expenses, especially during leaner times. So cash is king. I would say cash flow is king. And advancing facilitates cash flow. You see, if you only get paid every time the client pays monthly, you're getting paid 1/12 of the income instead of 75%. You're getting paid, what, 8% of the income instead of that, roughly, maybe somewhere in there. Yeah. So there's a big cash flow difference between 8% of your commission up front versus 75%. And while there is a financing risk, with the 8% risk, you now have other problems in your business like cash flow problems. You're probably not going to be able to afford leads after a while getting paid 8% of your commission monthly versus a 75 upfront amount with a financing risk. So the idea of not getting advancing to begin with, to me, is something I don't endorse, because you're trading one set of problems which are manageable with another set of problems that are almost entirely unmanageable. Because where are you going to get your money to buy leads? Most of us, I know in my position, I had 4 credit cards maxed out. I had 1 credit card left to buy leads, and it was like a $4,000 line. That was it. I didn't have any more leads after that or money to buy leads. So I needed to have cash flow capability and have it advance. So hopefully you see where I'm coming from. Okay. So chargebacks are real. They're going to happen. You can't put your head in the sand and pretend they're not a problem. You have to, in my opinion, especially in the life insurance side, accept the realities of getting an advance as opposed to saying, well, why not take one? Because we've talked about the cash flow reasons. So Dave, if I'm in a situation where I have to have advances, what can I do to mitigate the chargeback potential that may happen when I write business? And that's where we're going with this. So let's start with point number 1, because these are all things that I think, generally speaking, are pretty much in your control. Now, again, you can't control if Mildred changes her mind. You can influence her, but sometimes it helps. Sometimes it doesn't. They're just going to lapse the policy anyway. Some people are just like that, right? So we want to talk about the things we can control, not so much worry about the things we can't control, and know the difference, right? Isn't that the serenity prayer? So we're applying applied serenity prayer is basically where we're going with. Okay. So number 1 way you can control is how you sell. So what do I mean by that? If I walk into Mildred's home, our archetypal final expense prospect, and I'm going in there with the used car salesman mentality, I'm going to close this woman. I'm going to charge the highest price. I don't care what she thinks. I just want her money, no matter what good it does or bad it does to this person. If you go into a sales call with that kind of terrible mindset to take as much as you can without care of solving the problem and while keeping it reasonably affordable for the client, what you will end up with is many of these clients will acquiesce. They'll just buy from you because you're so aggressive in pitching them. But as soon as you walk out the door and go to the next appointment and pat yourself on the back that you closed it, guess what Mildred's doing? She's calling up your insurance company. She'll do it today or tomorrow or the next day. And she's saying, hey, cancel that policy. I don't want that guy over here. He's too pushy. I'm not interested. There was one agent that I talked to who was with another company, well-known MLM-based company. He said, there's a guy out of Knoxville, I live in Chattanooga, that was the #1 producer for this district. Not only was he the #1 producer, came from the car business, he was also the #1 in lowest persistency. and persistency means how much of your business do you keep on the books? So he sold a bunch, but he lost a bunch, right? And that kind of not always goes together. as we'll kind of describe ways to avoid this, but this is the thing you want to avoid. One truism of the insurance business, final expense in particular, really all of insurance, it's not what you sell, it's what you keep, right? You can sell a lot of coverage, but if you can't keep it on the books, what good is it? Didn't do your client good. You got to sell policies that stick. The stop policy that pays, policy that stays is the policy that pays, right? So that's how we have to think. And part of that process is also selling in the right way. So at the Ford Insurance Group, and what I teach really in all my YouTube videos, the insurance sales success training site and everything, is that you have to be client-centric. You have to sell in a way that you're enthusiastic, that you really feel in your heart of hearts that your client should own this. But there's this middle ground that you got to walk where it's not all about you and being aggressive and pushing somebody into it, threatening like the typical salesperson that we think of. We want to avoid that, but be more like, I would say the best description is like an evangelist for life insurance. You really have to believe that this product saves lives. And you have to insist in a positive way, not a negative way, that today is the day they need to buy. And a lot of that comes from your energy level, where your heart's at, also how you sell. So a couple of things that I like to use and incorporate in our final expense presentation is open-ended questions. I think it's better to influence somebody based on them agreeing that they have a problem, not just logically, but emotionally. And to get somebody to change their mind is really hard. And it usually doesn't happen by telling somebody how to think, but helping people see the alternative and giving them the autonomy to make the decision and see for themselves that this is the right way to think. Perfect case in point. If you try to argue with somebody online about politics, how many hearts and minds have you changed on the opposite side of the aisle? Probably zero. People have their opinions. They think what they're going to think. And it takes a person who is respected and appreciated by that person, in many cases, for them to shift their mindset. So I don't believe in like aggressively pushing people to buy. I show people what reality is. I ask them questions like, God forbid, if you die tomorrow, how's this going to be paid? And then I shut up and let them answer. And I get them uncomfortable with those questions because as I ask and as they think and as they see what they didn't see, what I'm trying to tell them becomes self-apparent. They are going to die. They are at risk of death, 100% certain going to happen. So why wouldn't they have protection? Why wouldn't they protect their loved ones? We walk them through with more questions about what if they die and their kids have to pay for it? Could they pay for it? How would they feel if they had to pay for it? And walk them through that series of emotions. And what that does is it not just gets them like logically agreeing like, yeah, this is a good idea, but they see and feel the pain of their of making a wrong decision. It's like with my mom. I'll give you another story of how powerful this is and why, going back to how we sell to reduce chargebacks, we want to sell in this way, in this advocacy way. My mom was a smoker. You guys probably know smokers. They'll tell you, don't smoke. Like my mom used to say, don't smoke because she was on her second pack of cigarettes. And me nagging her never stopped her to smoke. What did stop her smoking was what? When she got tongue cancer and had to cut a part of her tongue out. I know, it's terrible. She's all right. But it was in that moment that she realized her death was real, that she shaped up and changed things. So all of this is to say that's how people come around to making decisions and changing their minds. It's life experiences. It's also helping people see things in ways they don't normally see. And a good salesperson will use open-ended questions in order to get that. The other thing we like to use that I think helps you sell more insurance and keep it on the books so you reduce chargebacks is to sell in a way that is comfortable and sell in a way that gets a budget that's comfortable to the client. The last thing that you want to do, ladies and gentlemen, is sell arbitrary numbers that have no relevancy or basis to what the client could or couldn't afford. Now, we don't really know what the client could or couldn't afford. They know we're salespeople, and if we throw a number out, they may just reactively say no until we show them more information. So it's hard to say for a fact what a client's affordability budget is or isn't. But what I like to do in order to test this, in order to ensure that we get a budget the client agrees to is called selling the premium. So what's selling the premium? Selling the premium is where instead of saying, here's a 10, 15, and 20,000 in the price, we say, hey, if I can qualify for a program today, can you afford somewhere between 150 and 200 a month? And we shut up, let the client answer. And if they say no, instead of arguing and pushing them into buying it anyway, we agree with them. Hey, that's fine. What if I can find you a different program and it was priced somewhere between $100 and $125 a month? We literally take any resistance they give us and then step down by starting high and step down until they end up, and usually it's 75 to 100 a month, until they end up saying yes to a budget range that they tell us themselves with 100% certainty that they can afford. Does that make sense, everybody? So by the time, and I get that early in the presentation, we teach our agents get that early, usually in 10 minutes or less. So when we come back in about another 10, 15 minutes, knowing their budget, we then show them a couple of prices, usually a 3-option good, better, best close inside of that range, and maybe the third one a little bit outside of it, just like a stretch goal. But knowing with confidence the clients that they could afford at least the low end of that budget. So what that does is I'm not in a position to push a client into something that's out of their budget. But in the same breath, with this selling the premium strategy, I can also reach for the highest premiums every single time, because the worst thing that happens as agents, well, that's not the worst thing, I mean, you get the sale, is that when you offer a good, better, best close, what do you think when the client picks the third option? You show a $50, a $75, and $100 a month coverage, and they pick the 100, like instantly. My thinking is, call it my greed glance, like, dang, should have showed 125. Probably would have bought that, right? We kind of squeeze a little more out of them. So while it's great to get any kind of sale, you know, don't want to be too greedy, right? It's a good idea as an agent to try to stretch and make the big sales when they exist, because some people will buy a lot of coverage if you only offer it to them. And if you don't ask, you don't receive, as the old saying goes, right? So in short, how you sell matters if you want to reduce chargebacks. Number one, be persistent but not pushy. Be client-centric with your approach. Make sure that you're asking good questions when it comes to pre-qualifying, getting the want and the desire and need from the client. And we really like doing a premium sale approach to make sure the client's budget fits, because we don't want the client to wake up the next morning and be like, geez, why am I spending so much for insurance? We want to have them feel comfortable with whatever that it is that they end up buying. So number two tip to reduce chargebacks, and this is what a lot of the MLMs won't tell you, a lot of the captive insurance agencies and the final expense won't tell you. It's not just how you sell, it's what you sell. Now, what do I mean by what you sell? So here's the thing. Final expense is a great business, but not all carriers look at underwriting parameters the same, and certainly not all carriers are priced the same. When you combine that with a market that is price sensitive, more so than I would say the average middle-class environment, we're typically working with final expense prospects who are low income, disability is very common, working class, people who maybe have a very little bit of savings, if any at all, and they're living mostly paycheck to paycheck. And you combine that with an elderly population base, 50, 60 and older, that probably has health conditions. If you walk into a final expense prospect's home with one carrier, sure, it's easy to sell one company with your captive insurance agency, but the consequences is you're product pushing. You're not going out to the market to see which combination of price and coverage serves the client best. No, what you're doing is pushing a product that almost never is the best combination of price and coverage. It's better than nothing. If a client can get a policy approved, better than it was before. So there is to say that. However, the issue at hand is that in the next 90 days, you can almost guarantee that I'm coming in behind you or another agent's coming in behind you to look at that policy, do an analysis of it, and then try to replace it if the agent feels that the client could be served better. Think about it. If I walk in and I see a client with XYZ insurance company, they are on a 2-year waiting period policy. They don't get any natural death coverage for the first 2 years. They're only 3 months into it, so they got another 21 months to go. They have COPD. They're not on oxygen. And yeah, they may smoke. That company, in this case, if the client dies, is not going to pay the full death benefit. They're also paying through the nose. Because I have multiple products, pull out a carrier and offer the client first day full coverage, immediate natural death coverage from the first day. And on top of that, the price is a little bit lower too. What do you think? Your fixed income clients with health conditions that are worried about paying final expenses that now realize that there's a waiting period, what do you think they're going to do? 8, 9 out of 10 times, no matter if you are the greatest and nicest agent ever, they're going to dump your plan and buy from me, because it just makes business sense to get the best value for the bang a buck that they have to invest, right? Because they're on a fixed income. They can't just flippantly throw their money around. And this is the consequence of what happens when you're with a one product company. And the outcome is that when you're pushing product, and it's almost never the best combination of price or coverage, your persistency rates drop. Remember that term, the amount of business you sell that doesn't stay on the books. So your kept rate is lower. So that means and translates into a lower net income. You're not making as much per month because there's a higher number of clients you're losing because of your inferior policy. Add to that, if you're just selling one product and not a multitude, there will be circumstances where you'll walk into other opportunities to replace, but because your product is high priced or not good or all encompassing on underwriting, that you will lose a sale you could have otherwise gotten. And there would have been an easy sale, but because you couldn't do better, too bad. Whereas if you were an independent agent, what happens there is you can sell more of those deals because you have options. And likewise, the inversion is true. As an independent agent with multiple products, what you sell tends to stick better, assuming you also sell well too. So if another agent comes behind you and they see you've sold a competitively priced product, no bueno, you're not getting that deal. You're not replacing that deal because you don't have the capability to do it because it's a good value. I'll give you a quick story. I was down in Gadsden, Alabama many years ago, and an appointment I ran, I discovered a client had a family benefit plan, $80 a month. And it was about a year or so old. And what I realized is that after doing some pricing, the client wanted more coverage for a better price, like a lot of our clients do. There was no way after reviewing pricing options I could replace it because family benefit Trinity Life is so competitively priced. Even if this client wanted to replace it, there was no way. And I had like 15 companies at my disposal. So I walked out of the home not being able to replace the policy because in this case, the agent wrote a good company that was priced well and couldn't be replaced. And that would have been a lapse to that client, but that agent, but it wasn't because he did the right thing and sold the right policy. So all of this is to say this. This is another way to control and reduce chargebacks. Sell the best policies. Sell competitively priced companies. Have a diversity of carriers that have underwriting niches so that when you walk into a client's home, what you sell actually sticks. And that you can also improve the client's coverage by replacing inferior coverage with better coverage more often. Now, the last option or last thing here that I think does a really good job at reducing chargeback risk is what I would term beating the client to the ATM. Kind of hinted at this, so let me describe what I mean and how in an applied way we take this concept and use it to help us win and keep more of what we sell. So our clients, newsflash, are not good with money. They suck at money. That's what they used to say all the time. That's still true. You don't get to 60 and 70 years old and not have life insurance unless you have problems managing and prioritizing your money. It's the way it is. Some people run into hard times. I get it. They run into disability. Life happens. So there's always that too. But there is a behavior pattern that's natural with some of our prospects. And instead of wishing it away, it's better to accept it as what it is and work around it accordingly. So a lot of our clients, even in 2023, when they get paid on the 3rd of the month, what they do is run down to their ATM, pull most of their money out, and then pay their money out in money orders or go pay bills directly with cash and leave very little in the bank account. And what happens sometimes is our clients forget that we're taking their money to cover their premiums. And invariably what happens is that if we are late to the party to grab their cash while it's still there, our clients will miss their payments and put us in a position to where our policy lapses and we lose the client. So another example of this is especially around holidays. So I think it was this year or last year, the 3rd of the month fell on a Saturday, okay, of July. 4th was Sunday, or the 3rd was Sunday and the 4th was Monday. That's what it was. We set up a lot of our clients for the 3rd of the month. The way the language reads on most carriers' draft forms is that they can collect the money on or after the date listed, assuming it's not a bank holiday. Well, on Saturday and Sunday, the banks are closed. No bank drafts can be done. We can't do it before. And then the 4th of July is also a bank holiday, so we don't get their money till Tuesday. Make sense? The other issue is that Uncle Sam pays them early when the 3rd falls on a Saturday, Sunday, or holiday. So they actually got paid Friday. And what do people do on 4th of July weekend? They party. They spend a little bit more money than usual. So the clients got their money on Friday, had all week to blow it on stuff other than our life insurance policy, and then we reach into their bank accounts Tuesday. Do you think some problems could have happened with that much time that has passed? I'm here to tell you yes. So this is the challenge of timing our drafts to, in other words, beat the client to the ATM. So how do you do this? What's the best way? The solution is using carriers that offer what's called Social Security deposit billing. Ingenious strategy. Here's how it works. It's very simple. The carriers that have it, not all of them have it, and it's been around for 10 years. I can't believe they don't. But the carriers that have it, the way it works is that you don't pick a draft date numerically. You align your withdrawal dates on the Social Security deposit dates that client can expect. So in this example of the 4th of July, we know well in advance that Uncle Sam's going to pay on Friday instead of Sunday because of the weekend, right? So if you were set up on a Social Security deposit billing carrier with final expense, you would have drafted the money at 2 in the morning on Friday, July 1st, as opposed to Tuesday, July 5th at whatever time. And you would have literally beat them to the bank. And that's how the good Social Security deposit billing carriers work, is they grab the cash early in the morning before the client is aware and can go grab it out. Because if you beat them to the ATM, and that sounds silly, but it's the way it is, and you get there, you get your money, then it's fine. And what we have seen with this is that when agents put an emphasis on using carriers that do Social Security deposit billing, the average persistency jumps 5%, sometimes even 10%. And why is that powerful? Well, if I keep 80% of my business and I write $200,000 a year, I actually write $160,000 a year, right? Does that make sense? Well, what if I can raise that to 90%? Well, instead of $160,000 a year, just by how we bill and collect money, I've now raised it to $180,000. I've increased my production by $20,000. If I'm making 100% in commission on each sale, I've increased my net income to $20,000 just in how we simply take the money and the speed at which we do. And literally that 5%, 10% bump in first year persistency is pretty consistent with the carriers and the agents that implement the strategy. And this is easy. Most people will be happy to just let you draft based on when they get their money on the exact date. It's not something that turns into an argument or a frustration point. It's really appreciated. Most people just don't want you to draft before the money comes in. They usually have a bad experience. But if you could explain to them, hey, we don't take any money until you get it the morning of, and the money will always be there when we take it. You'd never have to worry about that. They're always, almost 100% of the time, happy with that. So in preference, you want to work with carriers that offer this, who offer Social Security deposit billing. Let me give you a couple of carriers. We use a lot with Prosperity. Prosperity does an excellent job. They do Social Security deposit billing for direct express and bank accounts. Those are two forms of payment we accept with that company. Excellent job collecting it consistently. Also, Trinity Family Benefit Life does as well. I know Transamerica was the one that originated it. So they definitely do it. And then I think also American Amicable does it as well. There's probably other carriers that do it, but off the top of my head, I'm having a hard time recalling them. There are some carriers that are still good to use that don't do Social Security deposit billing, unfortunately. Like I wish AIG did it. We write a lot of guaranteed issue with them. I wish Guarantee Trust Life did it. These are good companies, but why they don't have these simple to install and set up billing procedures is beyond my understanding. But you should be preferentially, even over a case of a company slightly more expensive, I would preferentially choose the company that has Social Security deposit billing, even if it's a little bit more expensive than another option that doesn't have it. It's that powerful, makes that big of a difference. Okay, so in short, 3 ways to avoid chargebacks. Let's make sure you're selling with the client's interest in mind first and foremost. Don't come in and badger and harass the client to buy. They're just going to cancel anyway. Instead, sell according to their need, sell compassionately, but persistently. Be an evangelist for life insurance and ask good questions, and make sure you use a strategy that gets a budget that they 100% agree to. Second of all, make sure that you're a broker, not a captive agent. This is the #1 most compelling argument why I believe very few agents should consider a route where they just sell one company. There's a lot of other problems with that we won't get into in this video that I'll cover later. But one of the biggest issues is just a lack of diversity when it comes to products, pricing, and underwriting. You will lose more coverage and you will not sell as much coverage simply because you're in a position of pushing a product as opposed to a broker that is client focused, that is trying to find the best combination of price and coverage for the client with their many options. You want to be the guy with options as opposed to the product pusher. And last but not least, you want to make sure you use carriers that allow you to beat your client to the ATM. Use Social Security deposit billing first and foremost. Beat the client to the ATM to take the money before they do, and you will realize a significant increase in the persistency in business that stays on the books. And that's how you reduce chargebacks.